Tan Teng Bo from Capital Dynamics. Today's session is on a very specific topic. It is on the Extraordinary General Meeting, EGM, of iCapital.biz Berhad, ICAP for short. ICAP will be having its EGM or Extraordinary General Meeting in the coming Friday, 29 December 2023. The EGM will be conducted virtually so that shareholders who are away from Klang Valley will be able to participate in this EGM. And why we are doing it this way is because this EGM is extremely important for ICAP, but more importantly, it's very important for your investments in ICAP. It will, to a very large extent, determine what sort of investment vehicle ICAP will be in the coming years. So, what is the EGM about? It is on the proposed dividend reinvestment plan of ICAP, DRP for short. The DRP is being formulated, is being implemented in conjunction with the most innovative dividend policy of the world, which was announced by iCapital.biz Berhad recently. Now, for those of you who might have already forgotten, whether you're a share owner or not, you might have already forgotten what this unique dividend policy is all about. 2 months ago, on 21st October, I also conducted a session in YouTube and Facebook to explain what this dividend policy of ICAP is all about, how it really works. And remember, I said that this dividend policy is to allow you to have your cake and still eat your cake. That is remarkable, right? Now, just to recap what the objectives are, it is basically for the share price of ICAP to trade in a rational manner, right? Whether it's at a discount or premium to NAV, that is not rational. So the first objective is to make sure that ICAP's share price is trading rationally. The second objective is to allow share owners who want to have some form of regular income to receive dividends from ICAP. The third, no less important, is for share owners who want to retain their ICAP shares for long-term capital appreciation. Now, this is where its dividend policy is so innovative because it also allows you to enjoy long-term compound return from iCapital.biz Berhad. And also, lastly, we do not forget those people who may, for whatever reasons they have, who want to sell their ICAP shares. So I think it is fair that we try to achieve a share price where those who want to sell would be able to sell it at a fair price. Now, very quickly, just to recap, the dividend policy of the other companies listed on Bursa Malaysia would be based on a percentage of the profit of the company. For example, Maybank would say that their dividend policy is 40 to 60% payout ratio of the net profit reported by Maybank. Tenaga, 30 to 60%, Wellcall, Surya Capital, Maxis, and so on and so forth. The percentages will vary. The common feature found in all their dividend policies is that it will always be a percentage of the company's net profit after adjusting for cash holdings, capital expenditure, tax requirements and so on. That is the typical dividend policy. Whereas for ICAP, what is so innovative is that it is a sum. It is an aggregate of two components. First is the base rate. The base rate is 1% of ICAP's net asset value. If ICAP's net asset value is 350, the base rate dividend will be 3.5 cents. The second will be the top-up rate dividend. Now, because iCapital.biz product is a closed-end fund, so its share price and its net asset value do not coincide all the time. There's a divergence. So when there's a discount, if, for example, the share price is at 3 ringgit and the net asset value is at 350, there's a discount of 50 cents. So this top-up rate dividend will take that into account, and the formula is 8% of 50 cents. 8% of 350 minus 3 ringgit, right? So that would be 8% of 50 cents, that would be 4 cents. So what we do is the total dividend of ICAP would be a sum of the top-up rate and the base rate, which would be 3.5 plus 4 cents, and that will give you 7.5 cents. The dividend will be paid on a yearly basis, right? And the top-up rate dividend will not be applicable when the share price of ICAP is trading at a premium to its net asset value. And to explain more clearly how it works, I give you two very simple examples. One on 17th of November 2023, where the net asset value 4-week average is 351. The 4-week volume weighted average market price of ICAP is 274.87. So there is a discount of 0.7613 cent. The base rate dividend will be 1% of 351, which is 3.51 cent. The top-up dividend will be 8% multiplied by 0.7613, which will be about 6 cents. So you add up these two, the total dividend based on the figures of 17 November will be 9.6 cents. If you look at it earlier, in 3rd of January 2023, where the net asset value was 3.305 and the 4-week volume weighted average price was 1.9844. So the discount of the share price to NAV is 1 ringgit 32.06 cents. The base rate dividend will be 1% multiplied by 3.305. So we get 3.31 cent base rate dividend. The top-up rate dividend will be 8% multiplied by 1.3206, which is the discount. So you get a top-up dividend of 10.56 cents. You add up these two, the total dividend of ICAP on 3rd of January 2023 will be 13.88 cents. In the first example, 17 November, the dividend yield will be 3.56%, which is slightly higher than the 3-month fixed deposit rate. In example 2, which is based on 3rd January 2023, the dividend yield will be 6.94%. I'm using these two real dates, real figures, to illustrate a few key points. First thing is, should the discount widen, then you as an investor will get compensation by a higher dividend in the form of a larger top-up rate dividend. Should the discount narrow, then what happens is your dividend amount will be lower because the discount is narrower, but you will get higher share price capital appreciation. So if you look at the two examples, 3rd January and 17th November, 3rd January the share price was 198.44, and by 17th November the share price was 274.87. So that in that 10-11 months, the share price of ICAP has gone up about 76 cents, which is about 36%, right? So you have enjoyed a very strong capital appreciation. Either way, you win. Either you get good higher dividend, or you get better higher capital appreciation. So this is what we mean by having your cake and still eating it. Now, just a quick recap again of the simulation that we did, assuming that ICAP's net asset value continues to grow at a compound rate of 8% per annum. So what will happen is that its net asset value will double in 9 years, which will be at 706, right? And the dividend per share will be 7.06 cents. Your share price would also, assuming that the share price is at a parity to the net asset value of ICAP, then your share price would have gone up to 706. So in that period of 8-9 years, your share price would have gained 161%. And you would have enjoyed a dividend yield of 1%, because this is the base rate dividend, which is based on net asset value. But what if there's a discount? If there's a 30% discount 8-9 years from now, so the share price, the net asset value will still be 7.06. The share price, assuming a 30% discount, will be 4.94, 4.94 ringgit. Your dividend per share will, in this case, be 24 cents, compared with earlier where I said 7.06 cents. So your dividend would have jumped up 17 cents per share. And your share price would still gone up, would have still risen. It would have gained 83% in that 8-9 years. So what it shows is that your dividend yield in this situation where there's a discount of 30% of 4.85. Your share price capital appreciation is lesser, but your dividend yield is higher. That is remarkable. I don't think there's any other listed company that has got such a dividend policy. And the base rate, the 1% base rate, is extremely important, because at, say, net asset value of 353, and the share price is 270, right? The earlier example that I gave you, your base rate dividend is 3.53 cents, and the dividend yield of 1.31%. So if the NAV of ICAP compounds at 10% per annum, so by 7 years from now, ICAP's net asset value would have reached 7.06. 1% of 7.06 would mean that you will get a dividend, a base rate dividend of 7.06 cents and a yield of 2.61%. So if you compare these two different periods, your base rate dividend will double from 3.53 to 7.06. Your dividend yield will double from 1.31 to 2.61. Right? So I'm just giving you a short period of 6-7 years. What this example illustrates is this: the longer you own ICAP shares, and or the faster its NAV appreciates, the higher the base rate dividend will be, and the higher the dividend yield of ICAP will be. You don't have to do anything, right? So, for example, in this case, if after 7 years you continue to hold, and after another 6-7 years it double again, right? Instead of 7.06, the net asset value now is 14.12. So 1% of the base rate dividend, 1% of the base rate of the net asset value would be 14.12 cents. And the dividend yield will be 5.12. So if you compare, right, a dividend of 14.12 cents with originally 3.53 cents and your dividend yield of 5.12% with a dividend yield of 1.31%, and you don't have to do anything. What happens is, because there is a base rate dividend which is 1% of ICAPs NAV, and ICAPs NAV has been appreciating, has been compounding at a certain rate over the last 18 years. So you automatically enjoy higher base rate dividend, higher dividend yield. And the longer you hold it, the better it is. If you project another 5-6 years, the figure looks actually pretty remarkable. Now, some people may want to receive their dividends in cash. Some may say, no, I don't want. I want to reinvest in ICAP. I want ICAP to keep the money and achieve further compound returns on my behalf. So this is where the DRP, the Dividend Reinvestment Plan, comes in, right? So when you receive it, you can have two options. Either take all cash or reinvest all in ICAP shares, or reinvest a portion of it in ICAP shares and take a portion in cash. The benefits to ICAP will be that it will improve the liquidity of ICAP shares. It will allow ICAP to manage the cash better in terms of dividend payout and cash inflow, right? And it's able to retain some cash for future investment. For you as a shareowner, you will have less hassles with the DRP. For you to reinvest the dividends, it will lower your transaction costs in purchasing ICAP shares, and it also allows you to maximize your returns, maintain your consistent compound returns through compounding. So the DRP is to enable all these benefits to be realized. Now, the question you may want to ask is the issue price of new shares, right? The issue price of new shares will be based on a certain formula. Now, I cannot disclose this too much at this point in time. I will invite you. We will disclose all these details in the EGM on Friday, 29 December. All I can say is that there's a certain formula to fix the issue price of the new ICAP shares. So make sure you come, right, and attend the EGM. Under the dividend policy, the innovative dividend policy, the DRP, they are all packaged together. And why it's important for you to attend? We need you to vote. If you really want ICAP to be successful over the longer term, over the next 5, 10, 15, 20, 30 years, then I think approving the DRP is fundamentally important to this direction. And your vote counts. We need just a simple majority, 51%, but in all kinds of election, in all kinds of democratic decisions, every vote counts. So I thank you, and I hope to see you virtually at 10 o'clock, 10 a.m., Friday, 29 December 2023. We will show you the slides later on how to register for ICAP's virtual EGM. There'll be details inside there, and we also show you details of the EGM, the issues, and so on and so forth, where it is, and so on and so forth, who to contact if you have technical problems, and so on and so forth. So once again, have a good weekend, and for those of you who are celebrating Christmas, Merry Christmas. For those of you who are just looking for a good, nice break over the festive period, have a wonderful rest, and see you 29 December. Bye-bye.